Fed's Waller breaks down a wall, or wool. The Federal Reserve will announce their rate decision on February 1st. The market's expectations currently is pricing in a 90-plus chance for a hike of 25 basis points to a target range of 4.5% to 4.75%. That comes on the back of a slowing of the CPI headline inflation. The last 6 months have seen only a 0.9% rise in CPI prices if you were to accumulate the month-on-month increases. That is less than the 2% Fed fund target if the pace is repeated in the second half of the year. On the employment side, there has been a slew of companies announcing job cuts as they cull the herd from the surge in job hires post-pandemic. Alphabet and Microsoft were some of the big companies not normally associated with cutting staff who announced cuts this week. Having said that, the initial jobless claims printed 190,000, the lowest level since April 2022, and the unemployment rate is still skimming along multi-decade lows of 3.5%. The Fed official shows some hesitation amongst the ranks to fully endorse a further slowing of the pace of rate hikes to 25 basis points, but there is a tilt with Fed's George, Brainard, Collins, and Logan all easing up this week. On the hawkish side, Fed's Bullard wants the central bank to get to the terminal rate finish line quicker by increasing by 50 basis points. He still sees the rate not at a restrictive territory, and at one point in November even said that 5% to 7% was his terminal range. Although he hasn't said that recently, he is still a hawk. On Friday, the last Fed speaker before the Fed heads into its quiet blackout period going into the February 1 decision, Fed's Christopher Waller was speaking at the Council of Foreign Relations. Afterwards, he had a Q&A with CNBC's Steve Leisman. Waller is considered more of a hawk, so would you expect him to toe the storyline that inflation was not fully dead, especially core inflation, that the Fed needed to keep raising rates and then steady for an extended period of time after reaching the terminal rate? And indeed, he did reiterate those things, don't get me wrong. However, he also explicitly said that he is in favor of a 25 basis point hike at the next meeting. Waller also broke down another wall in my eyes when he humbly said, "If the markets are right and inflation is coming down, that's great news." He added he would have no problem changing policy. Being a Fed official requires a conviction, I know. But let's face it, the conviction at the end of 2021, when rates were at 0% to 0.25% Fed funds range, with PCE inflation at 5.3% and core PCE at 4.4%, well above the target of 2%, was for the rates at the end of 2022 to be at 0.75% to 1%. Then in mid-June of last year, right after they raised rates to 1.5% to 1.75%, their conviction, the Fed's conviction, was for the end of the year Fed funds rate to be 3.25% to 3.5%. That projection from the best of the best economies was only a 6-month view with the best of the best data and the best of the best models in play. In mid-December, they raised rates to 4.25% to 4.5%, and projected 5% to 5.25% for the end of 2023. So hearing Waller say that if the markets are right, that is great news, and that he would have no problem changing policy is something new. I guess it still does not mean it will happen, and I understand that with unemployment still at 3.5% and coming off scary double-digit inflation in 2022, and after going out on Friday night with my wife and having trouble finding a parking spot, that the money is still in the pockets and flowing in the economy, and that might not lead to inflation melting away like Waller speculated and said that the market was pricing in. Nevertheless, Waller's confession is an acknowledgement that they don't know it all, and the reminder to us all, too, that if someone speaks to the markets or the economy with absolute certainty, to make sure you understand there are certainly no certainties. Having said that, technical analysis, which has different meaning to different people depending upon who bends your ear, says to me You see that price? That price is a reflection of all the Fed and central bank policy trends, all the economic statistics, all the economic models, or weather patterns, or debt ceiling fears, or geopolitical risks, or earnings risks right now. I think of all that stuff as the ingredients for a witch's brew. A little of this, a lot of that, a dash of that, and you get a finished product. The price for each second and minute and hour for each trading day. Now those ingredients change in real time, and what was once this witch's brew turns into something else. But technical analysis allows you to apply tools to that price like moving averages and trend lines and retracements. And if those tools are effective and followed by the market, it shows the tilt, the bias, bullish or bearish, and defines the risk where the bias goes the other way, and the targets if it continues to move in the direction that the price is going. It does that without emotions or fear or greed. So let's take a look at the technicals of the major currencies as we plow into the new trading week and get a view of what the price action is saying. And maybe I can break an anti-technical trading wall that you may have. Before I go into taking a look at the technicals that are driving the foreign exchange market as we head into the new trading week, I thought I'd take a look at some of the technicals that are driving the stock markets, the major stock indices, because on Friday we saw a breaking of some walls as a result of Waller's comments. So let's start by taking a look at the Nasdaq index. And if we look at this index, what catches my eye is the inability to move above the 100-day moving average, both here and here in the month of December. Price moved, tried to get above those levels, came back down, tried to get above, came back down. But in the last week's trading, we did move above that level and closed above it here and here. And on this day, on Wednesday, the market failed, and all things, the momentum to the upside was erased, and we started to see a rotation back to the downside. It seemed like the attempt was over, and then we got Friday's trade where the market rebounded, got back above that 100-day moving average, helped by Waller's comments, which doubled the Nasdaq index at the time. It was up about 1%, ended up 2.66%. So that was good news and a good push to the upside that got the price back above that 100-day moving average. And into the new trading week, we're going to need to stay above that 100-day moving average here and going forward if the buyers are going to continue to take more control. Above that comes the 38.2% retracement. That's this level right here. Then of the move down from the August high to the low that we saw right here. We need to get above that level at 11270. And if we're able to get above that level, we're going to have some pretty decent resistance up here that the market would start to target, including the 200-day moving average and these swing highs through here. So I'm not saying that we have the opportunity to get and extend above those levels. That's going to be a tough nut to crack. But we could see some further momentum up toward that level that would give the market traders something to, well, shoot for. And if they're able to get up there, I would expect some decent sellers against that level just because there could be because risk is defined and limited. It would take a move above that level to stay above that level to increase the bullish bias for the Nasdaq. We will see. But the first news of business is to stay above the 100-day moving averages in this index. If it's able to do that, that's good news for the Nasdaq index. Let's take a quick look at the S&P index. And similar to the Nasdaq index, the price moved above some key moving averages, daily moving averages, that had trouble in the past. In early December, we saw the price move above the 200-day moving average here, 1, 2, 3 days, and then fail. And then in mid-December, we moved above it, failed, and then rotated back to the downside. Didn't get any closes above that. And in trading last week, the market did move above it, 1, 2, 3 days, and then failed on Wednesday, came down on Thursday. Seemed like it was going to be all over. We're going to head back down below the 100-day moving average, back below this swing or trend line right here, but the market rebounded. And although it's hard to see, we did close just above that 200-day moving average. So hope springs eternal for the Nasdaq and the S&P that we're able to extend above the daily moving averages and continue the rotation to the upside. We will see. We have this trend line coming across here in the 61.8% retracement as targets for that. Get above that level. We could see the market try to rotate back toward the 4100 level. That was the high price right here. The 4119 level was a high price going back through here. So that's going to be a tough nut to crack, similar to what we saw in the Nasdaq on the top side for it. So we will see, but that would be the target if the market can continue its momentum and stay above the 200-day moving average in trading this week. So with that said, let's get into some of our currency pairs. We'll start by taking a look at the euro versus US dollar. I'll look at the daily chart here to begin with, because this is telling a story from a technical perspective. In trading last week, what did we see? We saw lots of ups and downs just off the daily chart, and week and beyond as a matter of fact. Go back 7 or so 8 days here, and the price has been up and down, up and down, up and down. But what we see here from a technical perspective is that the price respected this swing area through here, where we had a number of different swing lows and swing highs. Fell below that level, reestablished this level as resistance right here before rotating to the downside. On the move to the upside in December, we found early sellers against the bottom of that level, and perhaps a 61.8% retracement of this move. And then in the month of January, we came into that area, rotated downside, didn't go very far below that level, and then reestablished and was able to get above the yellow area here, but not to an extent that we wanted to. We wanted to see further momentum up toward this high area here. We have a number of different swing lows and highs through here near the 109.40 level. That's going to be our next target. So we rotated back down into this area, but stayed in it and above the 61.8% retracement. As you can see, on Thursday and Friday, we started to see a little more rally to the upside. So we're back above this yellow area. Close support comes in at the 108.05 level. Let's call it 108. Stay above that level is more bullish. And if we are able to do that, we can get up to the 109.40 level would be our target to get to and through. Get above that level and opens the door for further upside potential for the euro versus US dollar. All bets are off if the price starts to move back below the 61.8% retracement after this consolidation range through here. If that happens, then we should see further selling back down toward this swing area. That would be the target on the daily chart. Let's take a quick look at the hourly chart, because this shows some decent support down below, which gives us more of a bullish confidence, I guess. We did find support against the 200-hour moving average. Moved below it here, which was a bit of a worry, but the market couldn't sustain that momentum and quickly rotated to the upside. And as you can see, closed near the highs, retracing the full move to the downside here on Thursday and closing near the highs for the day. That led into Friday, where we had another up and down day. But in this case, the 200-hour moving average did hold support, and we rotated back to the upside into and retraced really the whole move up and down day on Friday, but closing near the highs. We have these swing areas on the top side here, which is going to help us define the momentum to the upside, get above these areas right here ahead of the high. We did fail above here, but reestablished resistance, get above this 108.74 level, opens the door, and then we're going to work toward the high and rotate above that, and it's open doors ahead for the euro versus US dollar. Let's take a look at the dollar versus yen next. And if we look at the daily chart in this pair, we did see on Wednesday the price spike to the upside. This is on the Bank of Japan move to not do anything. We saw the yen weaken, but then quickly rotate back to the downside. And later on in the week, we saw Kuroda come out and say, well, I wasn't kidding about the 10-year. We are going to keep pounding the expansionary policy. And that led to a rotation back to the upside here, weaker yen. But we are finding some resistance against the 130.38 level, which was a low price in December. Remember, need to get above 130.38 to push the market to the upside. On the hourly chart, what do we see? On Friday, the good news for the dip buyers is this, that the price did get back above the 100-hour moving average. This is our Wednesday trade, where the Bank of Japan and rotation back to the downside, and then lots of ups and downs through here. But on Friday, what we did do is we held the 100-hour moving average on the dip here. That gave the buyers a go-ahead to push the upside, and we were closing right around the 200-hour moving average. So these moving averages will be our short-term barometer for the week. Stay above the 129.35 level is the best case scenario for the upside. Move below that, and we'll move down toward the 128.87 level where we'll look for support for that currency pair. Let's take a look at the sterling versus US dollar. I want to take a look at the daily chart here to start off, and you can see how in last week's trading, the high price found resistance against the high price that we saw in December. It's sort of in a nowhere's land area here, not necessarily much to go on, except it was a high price in December, and the market stalled against that level again in the month of January. So in trading going into this week, we're going to need to get above the 124.45 level in order to open the door for further upside. And off the daily chart, I said this area through here as the next key target, swing highs through here that caused a ceiling through here, and the last thing it did was stall against that ceiling before rotating to the downside, never returning again. So we're going to until potentially this week, if the market is able to continue its move above the 124.45 level and get up to that 125.98 to 126.65 area, all the way back, going back to this period in April and May and June, where the market used that level as a ceiling. Now, on the downside, we could look at this swing area through here where we had another period where we had ceilings through here before rotating to the downside, came up to that area in the month of December and broke above it here only to fail. And when we moved back below that level, it was sellers pushing the price back to the downside in the month of January. We've seen the market rotate back to the upside. In the last few days of the week, we did find support levels against this level. This is a 50% retracement of the move down. This goes all the way back to this high through here, which is a June 2021 high. 50% midpoint of that level is also in play. So the 123 level down to 122.787 is going to be our risk defining level on the daily chart. As long as we can stay above that level, the buyers remain more in control, move below it, and it's more bearish. Taking a look at the hourly chart, or four-hour chart, you can see the resistance up here, move to the downside, move back to the upside here. If we turn that to the hourly chart and see if there's any clues through here, what we see off the hourly chart is the last move to the upside here and the correction on Thursday could not get below the 38.2% retracement near the 123 level. So keep that level in mind. Also, the rising 100-hour moving average is going to be in play for the sterling versus US dollar. Let's take a look at the dollar versus Swiss. And on the daily chart, what we notice here in the low this week is that there was a number, it found support against a number of different swing lows going back in time right through here, based here, then starts rotation to the upside. So there's a lot of reasons why the market found support in trading this week down at this level right through here. Just need to go back to in your history there. So 90.91 level is a good support level on the top side. We have another swing area, more recent swing area that the market contended with through here. These levels through here. And we tried to move below it here, but failed. And then in this month, or in the last week, we moved down below that level and then rotated back to the upside. We are currently trading around the 92 level, which is right here in between this level between 91.94 and 92.11. So if the market is able to get back above the 92.11 level, could open up the door for further upside here in the dollar versus Swiss. And that would be more bullish there. If we fail to do that, then we're going to be rotating back down toward the 90.90 level on the downside, with perhaps this level at 91.46 as a interim level. That's what we see on the daily chart. Let's take a look at the hourly chart in the dollar versus Swiss. And if we look at that, the high price that we saw on Friday's trade, where we find resistance right against the 200-hour moving average on two separate hourly bars. We also found resistance against here, and failed above it through here on one little bar. So the last 4 or so times that the market went up to the 200-hour moving average, what do? We found sellers. Now, the good news for the market, or for the buyers, if you're looking for further upside momentum off of the low here off that key support level that we saw down here in the 90s area, is that the price did hold the 100-hour moving average. So to start the trading week, we have resistance at the 200, support at the 100, and we'll be looking for a break either to the upside or the downside in the dollar versus Swiss. That's how I see that pair. Let's take a look at the dollar versus Canada. And on the daily chart for this currency pair, I put a Fibonacci here from this last low here. This was a pretty strong move to the upside here. And the 50% retracement of that level comes in at 130. Of that move comes in at 133.52. And in the 5 days that we saw last week, the market did find support against it on 2 separate days. And on Friday, we started to rotate back to the downside after trying its move above the 100-day moving average. The buyers had their shot above that level, couldn't do it, closed back below that level. We held resistance here. We moved above it here. We reestablished resistance against it on Friday's high and rotated back to the downside. So this week, on the daily chart, the story is about the 50% retracement and the 100-day moving average. Those are our two key levels. And if the market is able to break below the 50% retracement, it opens the door for further downside. If the market can't get below that level, we could see a rotation back toward the 100-day moving average to see if the price can move above that level. Now, we do know that the Bank of Canada does meet this week. And they're expected to raise rates by 25 basis points. But what they have to say is going to be interesting because what we know is in employment, we had a big, strong employment report, but we know that CPI started to come down a little bit. And, these tightenings in Canada impact the consumer directly because mortgage rates go up in Canada. Most of the mortgages are a variable variety, so that hits the pocket immediately when rates start to go higher. So that's going to be a worry for consumers in Canada for their economy going forward, which could lead to weakness. So we'll see how the Bank of Canada talks about that when they announce their interest rate decision. Do we see them leaning toward keeping rates steady, letting inflation come down, continue to come down, and try to stave off a recession, honestly? We'll see how that all plays out, but it's a different story in Canada because of that mortgage situation. So we'll watch the dollar versus Canada, watch 50% retracement, watch the 100-day moving average, a weaker Canadian dollar because of a weaker or a more a dovish Bank of Canada will, of course, push the dollar Canada to the upside, get above the 100-day moving average, see if it can stay above that level, but got to see what they say. Let's take a look at the Aussie versus U.S. dollars, our next currency pair. And on the daily chart, notice here is that the price for most of January has been above the 200-day moving average from this day right here, which is January 6th. The price has not closed back below that level, although the price moved up and then back down. This swing area through here is sort of a big swatch of different swing lows and highs, and I'm not necessarily in love with it. It was a good area through here, which sort of established the level as a swing area. We got a little messy at times with moves above here and here, but we reestablished it in the month of December, and then in early January we did the same thing, and we were able to stay above it through here. So it's really not that bad. It's just wide and real, 0.6824, 0.6892, so about 60 or 70 pips in between here and above the 200-day moving average. But we'll see. Watch the top of it at 68.92. It's near the 50% retracement, or the 50% retracement is at 69.15. Able to stay above that. That's of this move down right through here. Would be more positive for the Aussie versus U.S. dollar. It got a boost on Friday from the stock market moving higher. It got a move to the downside on Wednesday from the stock market moving lower. So it's a risk-on, risk-off type of momentum there in that currency pair. Taking a look at the hourly chart there, the hourly chart is showing some bullishness here above the 200 and above the 100-hour moving average. Notice here how the price did stay above the 100-hour moving average on the dip through here. So that's a more bullish bias there for that currency pair. Up here we have a swing area between the 0.6973 and 0.6984 level on the top side to get to and through. Finally, the last currency pair to take a look at that is the New Zealand versus U.S. dollar. And on the daily chart, we did find get above the 200 day moving average back in back here in the month of December, actually, and we had one day where the market closed below it and then closed back above it. We had other days through here in the early month of January where the price moved below that level but failed and started to move back to the upside. Had this swing area where the market found support right here and couldn't get good and stay below 200-day moving average to close higher and then started its rotation back to the upside. So the buyers are from a longer term perspective are trying to take control. The problem here is that the market is finding resistance or found resistance near this old swing area through here, where where there was a number of different swing lows, and then we had a number of different swing highs through here. That a floor becomes a ceiling that rotated to the downside, and in the month of December we came up near it, and the same thing in January this week. Wednesday, the market came up to that level and found sellers. So we're going to need to continue this momentum to the upside, getting above the 65.29, 65.73 level in order to push the market further to the upside here for the New Zealand versus US dollar. Watch this level on the downside for support. We'll see how that plays out. So there you have it, a look at some of the major currency pairs. My name is Greg Michalowski. I want to wish you good fortune in your trading. Bye-bye now.